Stop trying to time the stock market. Just please stop. Just don't do it. For all that is good and appropriate in this world today, just don't. You don't need to. Don't give yourself that headache. You don't need it. Here's the deal. We all know that one guy that invested in Amazon or Starbucks or GameStop at just the right time, and now they are this self-acclaimed multi-cajillionaire who knows everything about investing. When we come across that guy's path, we can stop and ponder for a second and say, what in the world did I do wrong? If that's you, today's video is about timing the market, what it is, and perhaps some other healthier options out there. My name's Trevor Cochran with Reverb Financial. Let's get into today's video and topic about market timing. According to one of my favorite websites, Investopedia, they define market timing as the act of moving investment money in or out of the financial market or switching funds between asset classes based on predictive methods. According to thebalance.com, market timing simply refers to any predictions an investor makes about price movement. So essentially, market timing rests on your own personal prediction, your own forecast, your own personal feeling of when to invest into a particular investment or the market as a whole. It's a really good guess as to the when and where to invest and holding a pile of cash on the side to get all in on that one thing. One of the greatest investors of our day, Warren Buffett, once said that the only value of stock forecasters is to make fortune tellers look good. Clearly, Warren Buffett's not a huge fan of market timing himself. But come on, Trevor, somebody's surely making it big out there. Why can't I? Well, you're right, some people are making it big out there, but what is the chances that you can actually succeed when timing the market? Back to our favorite website, Investopedia, on that same article, they continue. Sharp concluded that an investor employing a market timing strategy must be correct 74% of the time to beat the benchmark portfolio of similar risk annually. So yes, some people are doing well with their market timing, but that some people is not all people. In fact, that some people is very few people. Even more so, Forbes magazine says that those who are involved in day trading, which is a form of market timing, the probability of winning at day trading is 10%, and for those who win and do really well, the probability is around 1%.
So you're telling me there's a chance?
I don't know about you, but that's not the kind of probability I want to face when I'm looking to invest for my retirement or my kids' futures. As you well know by now by watching this video, we at Reverb Financial are not big fans of market timing. But what are we big fans of? Here are 3 simple principles to consider when investing in your future. Number 1, invest habitually, not haphazardly. When we invest habitually, we start following this principle of investing called dollar cost averaging, or DCA. What dollar cost averaging teaches is that when we invest a little bit every month, we are buying when the market is high, we're buying when the market is low, and everywhere in between. And by doing so, we can help reduce the risk of a portfolio overall by purchasing at different points in the market. What I like about this is not only is it creating a habit of investing in your life, but it's creating a habit that can lend itself into the next generation and last long beyond you. Number 2, simplify and diversify. Instead of looking for just the perfect investment and the perfect time to buy into the market, why don't we just buy a lot of different portions of the market so that we can grow and create a smart portfolio overall? When we diversify a portfolio according to our goals, it can help reduce the risk of our investment in a certain area while still helping us maximize our return for our timeline. And number 3, focus on your timeline, not today's headline. It can be so easy to get distracted by what's in the news today, the volatility of the market, what's going up, what's going down, and to use some of that data to let it feed into our emotions and create an emotional response to our retirement dollars. When we focus on our timeline, we can diversify our portfolio today and create different ways to help prepare us for different times of volatility in the market. Look, there has never been a better time to get free financial advice. If you're looking for another thought about how your portfolio is diversified or need some planning for the future to prepare for retirement, or maybe you're just starting with investing, contact us today. We'd be happy to talk and see how we can add a little bit more reverb into your financial plan.